Hello and welcome to MSI's final webinar of 2020. My name is Simon Mason and I'm the Sales and Marketing Manager at MSI, and I'm your host for today. Today's webinar is a dry bulk webinar, and I'm here with two of MSI's dry bulk analyst team, Fray and Stuart Grumbar. Before I hand over to the guys, just a reminder that today's webinar will last for 20 minutes, and there is an opportunity for questions to ask questions at the end. You can ask your questions using the Q&A panel to the right-hand side of the screen. And now over to, and just a reminder that if you don't get round to asking a question during the webinar, please do email us that question at the email address info@msiltd.com, and then we'll respond to you over the course of the day. But anyway, now without further ado, over to Will and Alex.
Thank you, Simon, and welcome everybody. What we're going to go through today is three sections. Firstly, we're going to talk through some of the impacts of fleet inefficiencies this year and what it's meant for the market. Alex will then talk through more of the demand supply fundamentals outlook and some explanations of what's happened this year. And then we'll quickly look into some key risks which are running alongside the themes of what we're going to talk through first. Okay, so we'll move on firstly to fleet inefficiency. So I think it's clear to anyone tracking the dry bulk market that the fleet has had some productivity change this year. There's been some big impacts on several elements of fleet inefficiencies, such as days in port and crew changes, as those elements like port practices have been hit by COVID-19 restrictions. It's really important to note that we take these into account when calculating demand in our model. So for a quick recap for those dry bulk clients, we track bilateral trade by cargo group, and each trade in million tons is then converted into an annual average required capacity to ship that cargo based on inefficiency factors such as speed, port days, ballast ratios, and of course the distance is taken into account as well. So these efficiencies are all in our model. They're not always easy to measure. Even speed, which should be straightforward, actually trying to extract what is a theoretical ideal trading speed and what vessels are doing is not necessarily easy to track. And port days also, not just when vessels come and stay in port and how long they're there for, but also when they slow down and whether they're anchoring, how far outside port. So it's difficult to measure, but we do make allowances and we measure where we can. It's important to note that it does have a big impact, and particularly has made a huge impact this year, and we can use these efficiencies through our model to understand that impact. Now, if we had kept in the model all of the efficiency measures, port days, etc., this year the same as last year, then actually we would have measured a fleet employment rate below where it was in 2015, 2016. In fact, it would have been the lowest measured through our model history back to 1980. So through history. So having these, understanding these inefficiencies is really important. Now, what this chart on this page is showing you then is an investigation into one of these aspects of inefficiencies this year to try and help understand. It was looking into crew change diversions, which we wrote about in our Q4 report, and essentially looked at some key routes, Cape-size routes from Brazil to China, Australia to China, and seeing how much diversion via Manila would add to a voyage. and then taking some very high level assumptions on assuming for every bulk vessel, maybe they change crew 1 or 2 times this year, perhaps one of those involves diversion. If we then use the ballast ratio to effectively increase the voyage time to take into account these diversions, then what impact does that have on the employment rate and on time charter markets? So what we looked at was, if we take those assumptions, then actually that would be a 3% difference in the ballast ratio. And you can see here from the chart then the impact on the employment rate might seem quite small, between 83% up to 83.5%. But you can see that the impact on the time charter rates is actually quite significant, rising from around $15,000 a day to $17,000 a day for Capesize rate. And if these efficiencies were actually more for other reasons, then you can see actually there's a big impact on the time charter market. Now, if I then just go to our next slide and looking at the impact on the market dynamics, we see that whilst we calculate trade has dropped by 2% this year, and actually if we translate that to ton miles, then that's not quite as bad because China's been taking some demand, which Alex will talk through a bit later. Actually, when translated to deadweight demand, we see a 2% growth. The last time we saw this dynamic was actually in 2009, when cargo dropped by 2.5% year on year. Ton miles are down 1%, but actually demand increased by over 4%. That was largely due to slower speeds, actually. But Capesize rates back then were on average $33,000 a day. The real crux of this issue then is actually what does it mean for the outlook? And this is the most important point, really. What we want to really be highlighting in this webinar is in our base case view, we can see quite strong trade outlook for next year. Again, Alex will talk through that shortly. But what if these fleet inefficiencies that have supported the market this year also unwind next year? And that's what we expect in our base case. Essentially, we've got support to trade from a world response to COVID-19, being the vaccinations are effective and rolled out, and that improves industrial cargo demand, and also we see inefficiencies come off. But what if those inefficiencies coming off then mean that the demand growth next year might not be as strong as the trade or even ton miles suggest? So we will explore some of these themes a bit later, but what we'll do now is I'll pass you over to Alex to talk through then some of the trading and supply dynamics.
Great, thanks a lot, Will. So as mentioned, I'm going to give you a very quick market outlook. So firstly, walking you through demand side, then onto the supply, and then putting together the two sides to give you a forecast of what we think will happen with market balances. So firstly, on the demand side, so a quick demand summary. So China has been the main demand driver across different commodity markets, particularly in the second half of this year. So as we can see on the left-hand side with this graph, which illustrates this quite nicely, we can see that there's been growth in both iron ore markets and grains markets, with China being the instigator of this strong demand in both of these markets. Iron ore has been driven by a huge Chinese government stimulus, which has been very steel intensive, and grains is largely down to recovery of the Chinese swine herd following African swine flu. And this has led to record soybean exports in Brazil and very robust volumes coming from the US in recent months. While on the weakness for demand, we can see that it's clearly been coal, and coal is down by around 150 million metric tons, so a huge loss in demand from coal this year. And this is primarily because of less import demand from two particular regions, Western Europe, firstly, and also India, which has also had a large reduction in coal. Also, China in the second half of this year, demand for coal has also slowed as annual quotas have been filled up much earlier than anticipated. And overall, because of coal, seaborne cargo volumes have dropped by around 2%, as Will mentioned. And if we look at the graph on the right, well, this illustrates quite nicely the area which Will discussed of why there is a 4% gap in cargo demand and deadweight demand. And this is because of the fleet inefficiencies, largely caused by COVID, such as crew changes and loss of productivity in various ports around the world. So moving on, so what is our forecast for demand next year? Well, recently we saw that China's GDP is forecast to be at around 8%. So this is a great sign for continuing robust Chinese demand in global markets. And we expect markets around the world to recover, which have been very dormant this year as COVID has affected growth in industrial demand. And reduced restrictions and less lockdowns next year as economies recover from COVID will undoubtedly help drive industry growth. So all in all, we're very bullish regarding demand recovering next year with around 7% growth in commodity seaborne demand. And tonne miles will grow even more than this, as Will mentioned. So we now move on to the other side of the equation, the supply side, just to give you a quick insight. So this year we saw very strong incremental supply growth, actually the highest we saw since 2014. So it's really quite strong. And this is because of extremely strong deliveries, particularly in the non-geared sectors. And also not as much scrapping as we anticipated. So what's our forecast for next year? Well, we believe that incremental growth will be quite a bit less, around 12 million deadweight tons, so about a third of what we saw this year. There's still around 3% of growth of the fleet, so it's still relatively strong historically speaking, but slower nonetheless. And this will be helped by lower deliveries and also higher scrapping, because we believe there's going to be quite a bit of pent-up scrapping demand. Particularly, we will see this when bunker prices rise, which we think they will do once the world economy recovers from COVID. And this will make the older vessels less competitive and force owners to scrap these vessels. And beyond next year for supply, well, we think it's quite difficult to see owners ordering new ships until there's more clarity over both low carbon fuels, propulsion designs, as well as further clarity over regulations from the IMO. And at the moment, we have a very low order book, around a 40 million deadweight, and we don't expect to see a large increase in this. We don't expect to see much more contracting in the near term. And this growth in the fleet this slowing of growth in the fleet in the year to come should help support market balances. But it's important to note that this year's strong fleet growth will no doubt be felt across vessel segments, particularly for non-gear segments, as I mentioned earlier. So if we now move on to the market balances, putting together the supply and demand. So what can we expect from next year's rates? Well, we want to stress that inefficiencies will wind down at some point next year. So it's unlikely that there will be a large improvement in rates, even though we'll see a lot more cargo volumes in the market next year. And over the medium term, demand will slow, particularly in iron ore and coal trades, which are both approaching peak levels. but really, which underpins our growth in market balances, is a low order book, and this means that market balances and freight markets should improve throughout our medium-term forecast. An incremental deadweight demand growth is actually slightly higher than supply, indicating improved fundamentals throughout our medium-term forecast. But lastly, I want to reiterate that a prerequisite for improved freight markets is the maintenance of this low order book. And when there's low order book and a lot of volatility, this can lead to speculative investments, and this has potentially has a potential to derail any market recovery in freight rates. So that's it from me for the market outlets. I'll pass you back to Will.
Thank you, Alex. So we're just going to touch on some market risks, which the themes we've talked on earlier. In our fourth quarter report just been released, we published a low case scenario on the back of assumption that there would be a delay to the rollout of vaccines this year, and there would be further outbreaks of COVID, and the core kind of measure of that would be global GDP growth at 2% rather than 5% in our base case. And the impact would essentially be to delay the recovery. So we wouldn't have as much trade in next year. We'd have slightly more incremental growth in 2022 than before. But overall, those volumes would be less. Now, in the way we model the market, we can see what the impact of that is on market balances. In this case, we've shown the impact on the Capesize 1-year time charter rate next year, but we also model the impact on the supply side response. Now, what should be noted is that in this scenario of a weaker demand outlook, there isn't a lot of room to reduce our estimates for contracting, nor a lot of room for more scrapping. So there isn't, if in a world where we've got lower demand outlook, then the supply side doesn't have a lot of room to lay that foundation for recovery. So it takes longer than for the employment rate to recover. So we have adjusted our contracting down, scrapping slightly upwards in 2022, 23, and in that case we do start to see a recovery beyond that time, but it will take time. On the other hand, if we do have further complications from COVID this year, something that we haven't modeled in that particular low case is the potential for inefficiencies to continue. So on the right-hand side, we have taken a separate scenario. We've taken our base case, and we've just halved the rate of improvement for the fleet inefficiencies, port days, ballast ratios, etc. And you can see that positive impact it would have on time charter rates. So this is done to give you then just to understand the relative effects of both, and the fact that they both could balance each other out. So overall, a fairly cautious flat time charter rate outlook for next year we don't think is unreasonable, and if with all taken into consideration, we would suggest that the risks we believe are actually on the downside next year rather than the upside, and certainly Vale's latest indication that their iron ore exports would be less than expected next year is certainly feeding into that feeling that we think the risks are potentially on the downside. Okay, so that was the end of our and I will now pass you back to Simon. Is there any questions?
Yeah, thank you very much, Will and Alex. Now's the time for questions. We've had some questions come in. The first question from one of the participants asks, how do you think China's ban on Australian coal imports will affect the markets?
Okay, so clearly, I mean, I think the point is that it'll have a bit of a kind of round the houses effect in that if China's going to drop its coal imports from Australia and obviously officially announcements coming out saying they are, then they're going to divert their requirements elsewhere, either from domestic coal, from Indonesia, from Russia, particular. So coking coal requirements from Mongolia and Russia a bit, and then it's steam coal from Indonesia. So not necessarily meaning that the total global trade will decline. It might mean a bit of a shift because that Australian material then would perhaps go to India. What would have gone from Indonesia to China would go to India would go to China, and India would take it from Australia. I think that on balance, you'd say that there's probably a slight downside risk to coal volumes. And what you'd expect to see is that China's obviously they import coal in Capesize vessels as well as Panamax from Australia, so that Capesize route will disappear, and it's really how much, not disappear, but the decline, how much of the Capes can then take elsewhere from Australia, potentially into India, the Capesize ports. There's going to be not a lot of elsewhere room to grow, really. You're not going to get much Australian shipments into Southeast Asia, another area for growing. So overall, it's probably weaker for the Capesize market than for, say, Panamax and Supermax, who then end up trade just redistributing a bit. Okay, hope that answers your question.
Thank you, Will. A second question, very much looking ahead to 2021, is how do you expect the Biden presidency to affect dry bulk shipping?
Alex,
okay, yeah, sure. I can answer this one. Well, we can expect that. I mean, it's very difficult to tell how it's going to play out diplomatically between China and the US. But we can kind of expect that Biden should be positive for dry bulk markets, as generally you would expect him to favor less protectionism agenda than Trump would, certainly less tit for tat policies, less aggressive confrontational trade policies for sure. But however, I don't think there's going to be any really substantial change, particularly in the short term, as Biden's likely to be focusing on the domestic economy. That's going to be where his priorities are. So there's unlikely to be any real substantial changes in policy. Also, I would say that the Senate is obviously going to be Republican. So it's going to be very difficult for Biden to really implement many changes, particularly early on in his presidency. Obviously, the longer the presidency goes on, that's more interesting. It potentially changes could be. And currently we are seeing obviously very strong grain and soybean volumes to China, and this will no doubt continue under Biden. So this is likely, to be positive for grains, continually positive for grains. So that's a positive dynamic. For coal, I think the outlook is probably less clear. Obviously, Biden is very pro environmentally friendly policies against kind of carbon intensive fuels such as coal. So potentially domestic coal consumption might come under pressure from Biden, and this maybe could free up more room for exports. We might see more US coal in the markets, but really it's all price determined of where exports are traded, how much US exports are demanded around the world. So potentially there could be positives for coal as well, but the outlook is less clear. So really, in short, it's all really to do with Biden's interaction with the Senate. That's really important, but likely to be positive on the grains front, continually positive. We expect strong volumes to China to continue. But regarding coal volumes, the outlook is potentially unclear, but could well be positive, at least in the medium term.
I think I can add a bit to that. I think Alex is quite right. On the coal side, though, it's very much how much will he effectively support domestic production? Is that balance between reduction in consumption and also what is it to do to support domestic producers? And as Alex says, it's very price driven. Now, in an environment where we already have peak coal trade, and in our outlook now, we tie in our long-term forecast into views published by the IEA and BP and others, and increasingly those scenarios are weaker and weaker. So we have peak trade in 2019, and then trade's flat for a bit, where Indian and Southeast Asian imports offset decreases elsewhere. But in the long term, that's going to come off. So it's very difficult to see a world of weakening coal demand that the US has a role to play in providing that coal. So with or without any support to production from Biden, if we're expecting to see domestic consumption declining in the US and globally consumption declining, then the US will probably take a hit. So I think that on balance, maybe there might be some short-term positives, but overall, in the longer term, we think that I think that the installation of Biden and his pro-green policies, even though he's pro-trade, and what's happening around the world, will mean that US coal exports will decline. Okay.
Thank you very much, Will and Alex. That's unfortunately all we've got time for today. I'm aware there's a number of questions that came in that we haven't got around to answering. We will look to get back to you over the course of the next few days. All that remains for me to say is thank you very much for taking the time out to join us. Please do look out for future MSI webinars next year. And also the PowerPoint, the sort of PowerPoint document and the recording of today's webinar will be available over the next few days on the MSI Horizon interface to download. And thank you once again for joining us, and wishing you all, from myself and the guys, a wonderful Christmas and a happy 2021. Bye bye.